Good afternoon, everyone. On behalf of Barclays Relicare Securities, I would like to welcome you all to our mid-year strategy webinar. So this year we have seen heightened uncertainty due to geopolitical tensions, which has triggered sharp volatility in commodity markets, particularly oil, increasing inflationary pressures and also keeping interest rates elevated. Yet, as our theme suggests, from conflict to confidence, we still believe uncertainty creates investment opportunities. Our team today is here to convince you to see beyond and act ahead. To start off things, I would like to introduce our team, starting with Ms. Maheshi Wattegedara, our macro analyst, who will take us through the key macro developments in shaping the market, and followed by Mr. Heshan Shamika, our strategist, equity strategist, who will present the market outlook and also investment strategy. The rest of the team will take you through our key recommendations. Please feel free to ask questions. Please send in your questions using the Q&A box, and we will take it at the end of the session. So without further ado, Maheshi, over to you. Thank you.
Yeah, so hope I'm audible to you all. So welcome everyone again for our mid-year strategy report presentation. So first I'm taking you through the mid-year macroeconomic outlook. So over the next 20 minutes, I'll walk you through our macro outlook, which we sent out on 3rd July. At the end of this part, I'll spend a few minutes on what's changed globally and locally since we published it. So this is what we are planning to cover today. So during the first part, we are going to take you through the report itself, and the second part, there will be a few points about what happened recently during the last week. Okay. So with that, let's start with the numbers. So this is the snapshot of our economic forecast. So you can have the full snapshot in our report. So in here, you can see 2026 GDP growth, we forecasted at 3.6%. And for 2027, we expect 3.8%. And export growing to $13.4 billion and imports to $23.2 billion. And current account that we expect to stay in a modest plus of 1.3% of GDP. And reserves are forecast to build steadily to USD 8.3 billion and remittance to record around $9.5 billion. Tourist arrivals, according to our projections, should hold around 2.4 million arrivals. So we will unpack each of these lines in the incoming slides. So this is kind of one-page reference for you all. So, okay. So here, these are the major macro drivers and risks we identified. So why we stay constructive on our economy in this report? So we found 3 drivers here. So first one is stronger than expected GDP growth led by manufacturing and services. So in our initial forecast, in January forecast, we expected only around 3% growth, but this time we revised it to 3.6%. Then the exchange rate, you can see, although we have seen some steep depreciation in May, again, we can see how the exchange rates bounce back, and we can see some stability. And even when it comes to reserves, we can see broader stability. So that is another reason. And the third one is the most important thing when it comes to equity market. In Sri Lanka, we know that we have tax-free capital gains. So those are the 3 drivers we mainly identified from macro front related to our equity positioning. And on the other hand, we identified key risks. So mainly it is about renewed geopolitical tensions. Then we can see the inflation pressures coming from that, and external sector pressures from wider trade deficit, and there could be adverse weather impact, especially with the anticipated El Nino hitting agriculture and hydropower sectors. And as the last point, we have weaker global demand from US and European countries mainly. So, yeah. So with that, let me take you through each economic indicators. So the first one is GDP growth. So on growth, you know that in the first quarter of 2026, we had 5.1% year-on-year growth, a stronger that is the strongest first quarter since 2021. So, and that is despite the cyclone Ditwa impact and the first wave of Middle East tensions earlier in the year. So that's why we said we can see stronger than expected performance in the economy. So that resilience is why we revised our full year forecast up to 3.6% from previous 3%. And manufacturing and servicing are doing the heavy lifting, while reconstruction activity is progressing more slowly given the elevated input costs. And with that, we see 2027 as the next leg of the recovery, moderating inflation, industrial activity, and more external resilience, which should support corporate earnings across cyclical sectors as current risk is. And moving on to inflation. So inflation experienced notable upside shock in the first half of 2026. Mainly driven by fuel prices, petrol and diesel. We know that it up an average of 45% by the end of June. And when it comes to electricity tariff, we can see it is up by around 18% in May. So that's a classic cost push inflation. So that therefore the headline inflation driven by higher global crude prices due to this Middle East conflict, and that fed through transportation, logistic, and manufacturing costs. So as of our forecast, headline inflation expect to be 7.6% by the end of this year, and average inflation for this year we forecasted at 5.9%. And so when we talk about we mainly consider the external volatilities here. So apart from that, potential El Nino event as the main upside weather risk sitting outside our base case. So with that, let's move on to external sector. So I'll start external sector with the trade. So export were resilient in first 5 months of the year, up by 7.6% to US dollar 7.39 billion. Mainly led by petroleum products, gem jewelry, ICT, and BPM services. Although we have seen our traditional exports such as apparel and tea lagged because of weaker UK and European demand. So India overtook the UK as our second largest export market. So when it comes to import side, the story was fuel and vehicle. So fuel imports rose by about 62%, and vehicle imports striking to 255% increase, which is why government introduced this temporary 50% customs surcharge on vehicle imports in May. So net as of the report, our forecast in the report, the export growing we expect around 6.3%, and imports rising by about 8% to US dollar 23 billion in this year. Moving on to the other two major foreign inflows of our current account, that is tourism and remittance inflows. So tourism, So I'll start off with the tourism. So tourism faced real headwinds in the first half of this year, mainly because of this Middle East tensions. So there were several disruptions on aviation and transit hubs, cutting average earnings per tourist by around 20% year on year in the first 2 months of this conflict. But India is stepping up through direct connectivity. So we know that that is the largest market right now. So plus a new 6 months visa waiver for 40 countries has cushioned the blow. So as our projections, we forecast 2.4 million arrivals for this year. And in terms of earnings, we expect 3.1 million US dollars in earnings, which is 4% decline. And when it comes to remittances, on the other hand, we identified it as the bright spot in this current account. So we saw a decade high US dollars 4.6 billion in the first half, which is up by 23% year on year, and increasingly diversified away from the Gulf towards the UK, Italy, and Australia markets. So therefore, we revised our full year forecast of 2026 up to US dollar 9.5 billion. Yeah. So with that, let's see how the external position, exchange rate, current account, and reserves. So putting the trade, tourism, and remittance pictures together, we do expect trade deficit to widen this year as import costs stay elevated, but strong remittances, stable tourism receipts, and resilient service exports provide a real buffer to the current account. So when it comes to reserves, reserves were broadly stable. So at the end of June, reserves are reported as 6.4 billion US dollars, despite meaningful external debt service payments and continuous pressure from on import bid. Therefore, we expect our reserves to build around 8.3 billion US dollars by the end of this year, and in 2027 end to be 10.6 billion US dollars. And when it comes to exchange rate, on the currency, Sri Lanka operates a flexible exchange rate regime. So we expect a gradual depreciation by near term, moderated by continued forex inflows from exports, tourism, remittance, and multilateral agencies. Moving on to interest rates. So on interest rates, the central bank has already raised its policy rates by 100 basis points to 8.75%, aiming to anchor inflation expectations and cool rapid credit growth. So as of our forecast, our base case is for a pause, no immediate further tightening with an easing cycle gradually resuming from mid-2027. And however, we did flag, here you can see, we did flag explicitly that a renewed commodity price shock could pose further tightening later this year. So before ending the first part, we have two more pieces. So the first one is private sector credit growth. So private sector credit was expanding fast, banking credit up by 24.4% year on year, and finance company credit by 52%. So this is mainly driven by vehicle financing and gold-backed lending. So that's exactly why central bank tightened rates and loan-to-value limits. And we also revised our credit growth forecast down to 8% year on year, which we previously forecasted around 11% year on year growth. And finally, on fiscal policy, so we can see a good performance for this year so far. So budget surplus, fiscal surplus is around 105 billion rupees in the first 4 months of the year, revenue up by nearly 35%, and continued adherence to IMF program we can see, and the fiscal discipline is a key pillar for this whole investment case in our viewpoint. So with that, we can wrap up our forecast in our report. So I just want to take you through a few points about what happened after we publish our report. So we published it on 3rd July. So after that, here's the sequence. On 7th July, tankers were struck in the Strait of Hormuz, and US launched 2 consecutive days of strikes on Iranian military infrastructure. So Iran retaliated against US bases in Bahrain, Kuwait, and on 8th July, President Trump declared the ceasefire with Iran officially over. So it escalated further over the weekend. So the US hit around 140 targets on Saturday, and Iran retaliated more broadly this time against the other countries as well, not only Iran, Jordan, Kuwait, Bahrain, and Oman. So with that, Revolutionary Guard claimed to have closed the Strait of Hormuz until further notice. So when it comes to shipping, in practice, shipping is continuing, but at reduced levels. So there we can see again some rerouting. So this whole flare-up traces back to conflict in US and Iranian regions of the interim peace deal they signed on 17 June about how Hormuz should reopen. So this is the case in Middle East. So for that, we can see how the market reacted. So oil has responded accordingly. Brent is back up to nearly 78 to 79 US dollar per barrel as of today's morning. So with that, we can see renewed tensions there again. So when it comes to other assets like gold, we can see gold. When I check today's morning, gold notably still hasn't rallied. So this is how the things happening in external front. So then let's see how it will impact on Sri Lanka. So bringing this to Sri Lanka, so June's inflation, we know that it reported at 6.8%, up from May's 5.5%. And we can see non-food inflation now running at around 8.4%, and we are closing in our forecast 7.6% year-end forecast, faster than expected. And when it comes to the rupee has also been drifting now weaker with central banks. We can selling price we can see see around 340 rupees. Tourist arrivals also fell by 9.9% in June, and the current account posted its second straight monthly deficit, while the official reserves fell from 6.87 billion in May to 6.45 billion, slightly, mainly due to the import pressure. So, however, we have seen one correction So oil prices were actually we saw in the last revision they had small cut. But going forward, we see still we have near-term risk if this current situation elevated. And so when it comes to so when it comes to IMF program, we believe that it is more important to maintain our policy discipline. We need to continue that to be on right track. And about the upcoming policy decisions. Right now we have 2 things to watch closely in macro front. So the first one is the central bank's upcoming policy decision. We believe that mostly it will be a hold decision, but a hawkish stance is a live risk if the oil prices up again and rupee keeps drifting weaker. And the second thing is how the CSE will react. So we will be talking about the equity market in our next part. with that, so these are the key things I want to highlight when it comes to macro outlook. So pulling everything together from the report we did and the latest development we had in the last year, there are 5 takeaways we identified. So the first one is the structural growth story is intact at 3.6% for 2026 based on our forecast. But geopolitics is now the dominant swing factor for the second half. And the second one is the Hormuz situation escalated further just over the weekend. So Iran is claiming a closure and Brent is back near 78 to 79 level. And the third one is inflation is running hot. So we forecasted to end the year by around 7.6%. And also we need to watch 2 main things, the upcoming policy decision and how this Brent oil will react to the current situation. So finally, so we need to be selective. So we, at the moment, we would favor domestic demand over the import-heavy oil-sensitive sectors while this situation remains fluid. So with that, we can wrap up the macroeconomic part. So we can move on to the equity strategy about how you should approach stock selection among listed counters in this situation. So thank you for listening. Over to you, Hesham.
Yes, thank you very much, Maheshi, for that comprehensive update on macroeconomic outlook. Now let's move on to stemming from those implications and overall BRS expectations. Let's look at equity strategy. Let me share my screen first. So as Nusrat earlier pointed out, the theme and the key area that is trying to be focused around, it's the from conflict to confidence, how that's going to happen, and the timelines around that, and what kind of maybe a early step that investors would have to take if they are to benefit out of a difficult situation that is there in the market. So PowerPoint is live and hope that is visible. Can somebody from research confirm?
Yes, Heshan, I think it just came on. Yeah.
Sure. Thanks. So with that, we'll move on, and good afternoon, everyone, and thank you for joining us. Today, we will be discussing our mid-year equity strategy. And before we begin, I would like to briefly touch on recent development, like Mahesh also pointed out. Since publishing this report, the geopolitical tension in the Middle East have intensified again, reminding investors how quickly market sentiment can shift. Rather than reacting to every headline, today's discussion focuses on what these events mean for earnings, inflation, interest rates, and ultimately equity valuation over the next 12 months. Our central message remains straightforward, although it's not a straightforward outlook that's going to be. It's going to be a curveball. However, near-term uncertainty may persist. Markets are likely to begin pricing the next year earnings recovery well before it even becomes visible in reported results. With that, let's begin with our overall market view. We remain selective overweight on Sri Lankan equities with an SPI target of 25,000 250 by end 2026. Before I go into reasons, I would like to highlight one important point. Our ASPI targets are based on 1 year forward earnings, because we have seen in the past market tend to look ahead. So our end 2026 target is based on 2027 earnings, not 2026 earnings. We believe most of the 2026 earnings are already reflected in today's market. That's why we see limited upside in the near term, which is only about 2.2% from the Friday's closing. The bigger opportunity is for the market to gradually price in the earnings recovery that we expect in 2027, in line with, if the things are to go in line with our base case. So that's why our recommendation is selective overweight. We are not saying buy everything. Instead, we are focusing on fundamentally strong companies that can deliver through the current uncertainty and benefit as conditions improve. Our view is supported by 3 key catalysts: easing geopolitical risk over time, although it's de-escalating and re-escalating. All these uncertainties are there. However, all these tensions and war situations cannot sustain for a longer period. If that is the case, it's going to be extreme situation, which is anyway going to be impactful in any kind of the macro indicators, not only equities. What we expect is at least this is going to be a managed risk more than a sustained risk going forward. In that case, it will provide an attractive entry point. Of course, we don't expect interest rate cuts in the near term. However, till it is happening, there will be opportunities for the long-term investors to come into the market at attractive entry points. That's what we are going to touch on today. And we also expect a recovery in corporate earnings from the subdued earnings that are going to be in this year. So we'll start with the first catalyst, how things have panned out. So the first catalyst, of course, it's going to be the de-escalation. Now that recently it has re-escalated. If you look at the previous timeline that is shown in the left side's hand, we saw tensions escalate sharply in June. It drove over oil supply concerns and global trade challenges. Latter part of the month and early part of this month, we saw headlines continue to fluctuate, but there was a de-escalation and prices have begun to correct. We saw oil prices hovering around $90 to $100, and now that has come down again. Recently, it has picked up slightly, still not at the peak level that it used to be. So what it shows that over the next 12 months, the geopolitical risk can gradually become more manageable rather than continue to escalate. Although the recent hype or the recent news suggests otherwise, but we have seen these things happen and again quickly come to other situation. So if you look at the slide here, there are indicators that have shown that when the tensions de-escalate, how things come down quite drastically, although it will reflect on a lag effect on the corporate earnings, but it come down if the de-escalation happen. You can see the peak level of forex premiums have come down, and then the freight rates have come down from peak level. The vessel traffic through Strait of Hormuz has come down from peak level. So those are some of the indicators that are pointing out if the de-escalation to happen, things can become quite better than what it used to be, so that the people who have come into the market at a time when the investors are exiting may be at quite a bargain opportunity. If we move on, the next catalyst, what we are looking at is inflation outlook. With that, it will directly interrelate with interest rate outlook, which is quite key for the stock market. As shown in this chart, we expect inflation to remain above the CBSL 5% target. Through most of 2026, it's already is. before gradually moderating in 2027. Mahesh presented our expectation of the inflation forecast. So as first glance, that may sound like a negative. Of course, for the short term, it's going to be a negative, but from an investment perspective, we see it differently. Higher inflation can delay rate cuts. The cap can keep market sentiment cautious. However, it creates better entry points for long-term investors. If you look at the past crisis situation or the past difficult situation that Sri Lanka were in, the stock market actually favored the investors who had taken a brave decision to tap into the market and has yielded quite long-term returns. So the history shows that the markets typically begin to recover before the first rate cut. So when there are signs of that first rate cuts happening, when the inflation is peaking out, that it's the time that the investors start pricing in improving earnings, but that could be little late if you are trying to look at a quite attractive entry point. That's why we believe today's environment is for positioning. So you should gradually come into the market rather than waiting. So when the inflation moderates and policy eventually shifts, we expect the market to increasingly focus on the next year's earnings recovery. With that, the three charts that we have shown here tells one connected story. On the left side, you can see the T-bill rates have seen a reversal from a bottom-out numbers. We expect those rates to remain at these level or slightly higher rates in the near term, meaning that it won't be as attractive with the equity returns. Probably fixed investors would be looking at it. And also, if you look at the daily average turnover chart, the year to date 2026 is quite strong in comparison to the historical averages, but still it's not as good as the last year. Of course, the 2026 first half was benefited from the first few months being quite strong. Going forward, at least for the next few months, we expect the turnover to remain relatively lower, meaning that there will be price weakness. And like you can see in the right hand side, the equity markets are forward looking, and this chart shows that the equity often begin to outperform fixed deposits when investors expect the rate cycle to turn rather than interest rates have actually declined, meaning that even during times when the interest rates are high, when there are signs and indication that the interest rates are going to reverse, we have seen that the markets performing quite well, than even higher than the higher returns that were offered by the fixed deposits at that time. So the short term is going to be a little challenging, but once you see the peak of the inflation and interest rates, that time maybe the pricing has already started, maybe little too late, but still that's the time that most of the investors are looking at. So we are coming into our final catalyst in terms of our equity strategy, which is the recovery that we see in corporate earnings. So we have revised down our earnings forecast or the earnings growth for 2026. We had 10% previously. We were actually factoring, and we have been slightly conservative about some of the developments that were happening and the fact that there was slight indication that a moderation is happening. So we are expecting that the earnings to be 4% growth to earnings to grow 4% in 2026, and then recover by 13% in next year to 833 billion. That is where the pricing will come in, and the markets will try to capture those earnings recovery. In terms of valuation, our valuation is derived on for the 2026 ending, and maybe the first half of next year is based on 2027 earnings. As I pointed out, we look at forward earnings rather than trailing earnings. We believe that 2026 earnings are largely priced in. That's why 22,250, which is the near-term ASPI fair value, and based on 1 year forward earnings or the next year earnings, the SPI fair value, what we arrived at a P of 11 times, which is the historical average P for the market, which gives roughly around 16, a little over 16% upside from the current SPIs. And the base and the scenario analysis or the re-rating conditions, if the things become or the interest rates remain here for a longer period, of course, the sentiment will fade out even more than what it is now. So we are probably looking at 10 times multiple, which has been seen during times when the things were slightly difficult. So in that sense, probably you will be looking at a lower fair value of 23,000. And if the things improve quite quickly than what we are expecting, and the interest rates again become trending lower, you will be looking at a slightly bullish multiple of 12 times, which we have seen during low interest rate regimes. If you are applying a 12 times P on our forecast earnings for the next year, you are looking at 27,500, which seems slightly out of hand at the moment. Most plausible outcomes at the moment is our base case 25,000, and then the bearish case of 23,000 if the things to go out quite badly. From that, we come up with our core recommended portfolio. So we look at the current conditions, the uncertainty, and how the companies have responded in the past for these kind of situations. Based on that, our largest allocation is centered around financials, which includes banks, two top banks, Commercial Bank and HNB, both voting and non-voting. Then commercial credit out of NBFIs and HNB Life or HASU from insurance, complemented by selected consumer companies. We favor these sectors because they tend to generate resilient earnings across different stages of economic cycle. From the consumer companies, we have the likes of Hemas, Sunshine, CIC voting and non-voting, and distilleries as consumers companies. Then the second half of our portfolio is little bit more leverage to the economic recovery, since we are expecting at least the first half of next year a bit of economic recovery. So we have positioned ourselves in selective construction, Access and ACL and Tokyo, and also some of the industrial export-oriented counters likes of HECAP, DIP products, and some of the technology-oriented PICME, and then the renewable energy, Vidul Lanka, and as usual the dividend counter, which is not more of a capital gain player. It is rather a dividend player, Chevron Lubricants. So while these companies may be a little bit more sensitive to economic cycle, they also offer greater upside as demand recovers and business confidence improves. So that reflects our overall approach being selective, discipline and valuation driven rather than chasing every recovery story. So we are playing the game of having a defensive counters and more resilient counters along with some of the slightly leveraged counters as an overall portfolio, accounting for all these volatilities. But one thing is quite common: all of them are fundamentally sound companies, have known to be quite resilient against most of the shocks that we have seen in the past. So let's look at individual theses. So our first high conviction idea is Commercial Bank. We maintain a buy on both Commercial Bank voting and non-voting. Both have upside over 20%. Voting has over upside of 20% and non-voting 16% upside. So there is a little bit of a mismatch with voting and non-voting price dynamics in line with historicals. So we favor voting more. We expect as our investment thesis, lending activity to moderate from the quite robust level or quite lucrative levels that the banking sector had seen in last year and first half of this year, especially with the recent policy tightening. We still forecast credit growth of 12%. Half of it's already done, and more than half of it, and it's purely a stronger first half. And at the same time, we expect it to be resilient in terms of credit growth, because not everything has slowed down. It is slightly slowing down, but still the economic activities are moving in. We expect NIMs to remain at 4.5% for commercial bank. We also conservatively forecast credit cost of around 1% of the loan book. However, they have strong provision buffers from last year, and even at the moment, they have quite a bit of a provision buffer, but still we forecast credit cost on the expectation of could be a slight migration of some of the loans into stage 3. However, how they have managed in the past with the better top line and some of the diversified streams that they have on their open positions and other investment avenues, we believe that the earnings will be resilient. There won't be much of a growth, but at least it will be resilient at the high numbers that they have generated in last year. So some of the risks are, of course, quite evident. If the non-performing loans becoming quite higher than what we are anticipating, that will have an impact on the earnings. Also, if the credit slowdown is persistent rather than a temporary shock, that could be a problem. And then the policy uncertainty that is especially related to the government part, but that is fading out since given that is stable government. So quite similar thesis for HNB, if we are moving on to that. It has upside over 15% for both voting and non-voting. Again, quite similar thesis, given that pretty much common factors impacting both of them, and the trajectory of their asset quality management and how they have built-in provision buffers and how they have managed their loan book is quite similar. They have been slightly aggressive in the first half, so we expect them to have a credit growth of 14%. The leasing growth was quite predominant in the first half. That is likely to slow down. However, still, what we expect is 14% credit growth. Group NIMs are expected to remain around 4.8%. And on asset quality, we forecast credit cost around 0.7% of loan book for HNB, reflecting a more cautious operating environment. Also, if you look at HNB, they have quite strong capital buffers, so they should be quite resilient against even at this current backdrop. And one of the most cheapest within the banking sector, so HNB is the second pick out of the banking sector counters. Then if we move on to the NBFIs, which is going to be little challenge in the current contract when the interest rate increase, NBFIs are worse off because they are slightly depending on deposits and their financing gets expensive. So when that happens, their NIMs get contracted. And on the other hand, when the interest rates are higher, of course, you can naturally expect the credit growth to slow down. So they had quite higher credit growth in last financial year, but we expect it to be slightly lower double-digit numbers, around 13% to 12% in the next few years, especially with the tighter loan-to-value ratios in relation to vehicles and also even in terms of gold loans. That is going to be temporary headwinds for the NBFI sector and commercial credit. However, they are one of the highest NIM earners. The NIMs that they generated around 16% is going to normalize in our view to around 14% to 15%. So still remaining well above the sector average. And also we forecast credit cost on a conservative basis that is going to be impacting their short-term earnings. However, the predominantly collateral-backed portfolio, it is likely to have a better asset quality than some of the other shocks that NBFI sector is going to have. So with the strong cost efficiencies and strong NIMs that they have, we still expect them to generate ROEs around 20%, which is quite robust. So the prices have come down. Even after revising downwards, the earnings and the valuation sentiment, Still, we believe that the current or the price decline from their peak level is not warranted according to our valuation. So we reiterate our buy recommendation on commercial credit. So that's about the banks and the finance NBFIs. And at the current backdrop, we believe that maybe some insurance sector is something that's going to benefit. So from that sector, we have HNB assurance that will be taken over by Iranga. Over to you, Iranga.
Thank you, Eshan. So moving to the HNB Life, the newest addition to our core coverage and our first recommendation in the insurance space. The target price we gave at initiation in March 2026 has already been achieved. So we have revised our target price, and we have raised a target price of 175 based on, so it is based on the last Friday's market price, represent an upside of 17.6% upside, and a total return including dividends, it is a total return of 21.9% based on the last Friday market price. So if we talk about bit on Sri Lanka's insurance sector has been one of the country's fastest growing, with total GWP expanding at a 5-year CAGR of around 13% between 2020 and 2025, primarily led by the life insurance segment. If we focus on HNB Life, HNB Life has been consistently increasing its market share year after year. Market share stood at around 8.6% at the end of 2025. And by first quarter of 2026, it had already climbed up to 11% from the life insurance segment, surpassing the management expectation and their strategic target of 10% for the 2026. However, based on our assumptions, we remain the 10% target for the 2026. So this momentum is basically driven by a few things working together. First thing is the channel performance. Channel performance has been strong, especially the bancassurance segment, while also their cost-effective distribution, especially they have introduced incubator branches, franchise model, has allowed the company to expand reach without heavy cost base. And layered on top of that is the deliberate push into undeserved market like SMEs, and the natural synergies that come from being part of the HNB group, including its relationship with HNB Finance. So this all together help them to expand their market share day by day. And if we focus on their financials, their retention ratio is really improving. Their policy lapsing ratio is declining. So that means their retention, their customer retention ratio is day by day improving, and the policy lapses are declining. So that indicate they are not only focusing on bargaining selling new policies, they also consider about the quality of their insurance policy. So we expect HNB Life's ROE to be remain within the 20% to 23.5% range within the immediate next 3 years. And we expect their forward P multiple around to be 6.9 times on current market price. So the risks are mainly the macroeconomic driven, increase in inflation, which led to decrease the customer disposable income, may reduce the demand for the insurance, maybe the natural disasters that suddenly happen, which increase the claims. So those are the basic risks, and along with the new rules and regulations is coming up, even the IFRS 17 rules and regulations. So those are the risks currently faced by the HNB Life and the entire insurance industry. So we can move into the next counter.
Yes, so with that, we move on to the consumer sector counters, starting with AMAS Holdings PLC. We have a target price of 45 rupees based on FY27 ending earnings. And the key catalyst, we believe, which positions Hema's for acceleration are the growth in the consumer brand segment, particularly driven by the underpenetrated segments, which are the beauty and the personal care segments, which are poised for double-digit growth. So given that these are very much underpenetrated, especially when it comes to sanitary napkins, the beauty care products, and so on, that leaves a lot of room for growth. And also we see that there's a lot of margin potential as they venture into premiumization of these product categories. So this will be a key factor driving the consumer brands of Hema's. And the other key driver is from the healthcare segment. So as you all know, Sri Lanka has an aging population, and there is a very high prevalence of non-communicable diseases. So with this, the requirement for healthcare services and pharmaceuticals is going to be very high in the future. So particularly when it comes to Hema's, they have their pharmaceutical distribution business as well as the manufacturing arm and also their hospitals. So all three segments we believe will benefit from this opportunity. And particularly we see a lot of margin potential in healthcare from the pharmaceutical manufacturing of the branded generic portfolio, as well as the expansion of the hospital services. So with this, we have identified the key investment risks for Hema's as the regulatory changes, especially the healthcare segment is subject to a lot of regulations, and there are delays from the NMRA side, and the pricing and so on. They're subject to all these regulations, so that brings somewhat of a risk in terms of Hema's business. The commodity price fluctuation, yes, it is somewhat of a risk, but not as much as what it used to be a couple of years back, because as they move on to their premium products, the exposure to these price fluctuations become less, and they have more pricing power. And they're also exposed to Forex, so those are the key investment risks when it comes to Hema's, but overall, we believe it's poised for a good upside of 40% on current market prices. So with that, we'll move on to the next slide on Sunshine Holdings PLC. So Sunshine has made a comeback into our recommended portfolios. So we believe with the given price weakness, there's still opportunity to capitalize on investment in Sunshine Holdings. So with a target price of 39 rupees, we believe there's upside of about 25.8%, which gives a rating to a buy. So Sunshine also, their main business comes in the healthcare, consumer, and the agribusiness, which is coming from Waterwala plantations. So we see healthcare, although in the near term, yes, as I spoke about Hema's as well, there are regulations, there are price controls, which limits the margin power to some extent. But we believe there is a lot of long-term potential, especially in the manufacturing side as well, where Sunshine is specifically focused on the respiratory drug manufacturing, as well as the recent joint venture with the Indian company also, I think adds some long-term value in terms of the healthcare side. And the acquisition of the joint agri-produce company is also going to add to their consumer segment top line, as well as given that it's a USD denominated earnings, that is going to be a buffer, which is key, which will be very valuable in terms of the current situation. And the agribusiness, the key player is palm oil. So the palm oil prices are remaining elevated despite some fluctuations. So that is going to be the key. Although the dairy segment is a bit of a drag on the segment, still we believe the palm oil pricing and the improved yields are going to be the key catalyst in terms of the agri contribution of Sunshine Holdings. So with that, we move on to CIC Holdings PLC. So CIC, we have target prices of 38 rupees for the voting share and 31 rupees for the non-voting share, with upsides of 22.6% and 22.5% respectively. So CIC's key business is the agriculture, mainly the crop solutions, the fertilizers and the agrochemicals, where they maintain market leadership. So, but what we really see as a strength here is, despite, yes, they have the market leadership when it comes to fertilizer, but even amidst volatilities to their core business, the diversified earning streams are going to mitigate this risk. So especially we see the demand for poultry and the feed related products to be strong in the near term, as well as the health and personal care segment, which is going to be a growing segment in the medium to long term. So there is export potential, there is potential in terms of growing the local manufacturing. So that will be a key segment, despite a somewhat slowdown that we see in the recovery of the industrial solutions, which is very much linked to the construction side. So there will be climatic risks as well as the regulatory risks and the exchange rate volatilities and so on. But especially since it's agri-related, climate risks is going to play a major role. But as I mentioned, the diversified nature is going to help them to be more defensive amidst all these external volatilities. So with that, we can move on to the next topic, which is DISTI. Mahesh, over to you.
Yeah, so let me take you through the last count on our consumer sector. So I'm going to take you through the Distilleries Company of Sri Lanka PLC. So here you can see we are rating DIST by recommendation. So our target price stands at 66 rupees per share, and with a projected 3 rupees for FY27. So that translates into total expected return of around 23% and price upside of 18% from the current market price of 56 rupees. So we have in here we have identified 3 drivers in this thesis. The first one is the market leadership and brand strength. So you know that Distilleries is one of the prominent hard liquor in Sri Lanka. So they have a flagship product. So they command over 70% of hard liquor market, and this dominant position combined with a strong brand portfolio gives the company real pricing power and supports steady volume recovery. And the second one is the broad economic recovery, which I spoke about in our macroeconomic outlook as well. So improving construction and industrial activities together with stronger tourist arrivals should lift spirit consumption across the country. So then moving on to the third catalyst, that is the margin resilience. So Distilleries brand equity allows it to pass through high excise taxes without eroding their profitability and protecting margins even as the tax environment tightens. So we know that when it comes to sin industries, typically we can see higher taxes even in the corporate income taxes also they have 45%. So we can see higher taxes when it comes to sin industries. So since they have this brand equity, they can easily pass on these cost pressures to their consumers. When it comes to key risk, so that includes mainly the regulatory and tax headwinds. Then we can see sometimes we observed even during previous years, there is a shift in consumer preferences due to these high prices. So that is one of the concern. And growth in illicit market, again, that is also related to this shift in consumer preferences. Because of the affordability, we can see in certain consumer segments, they are shifting towards the illicit market and counterfeiting and unfair competition in the market. So those are the major risks. Yeah, so those are the things I want to highlight about distilleries. With that, I think we can move on to construction segment counters. We can start with Tokyo. Over to you, Asif.
Yes, thank you, Maheshi. Good afternoon, everyone. Next, I will briefly take you through our recommendation on Tokyo Cement Company Lanka PLC. So basically, we continue to maintain our buy recommendation on both Tokyo voting and Tokyo non-voting. If we consider about the current environment, although the current operating environment has become more challenging due to higher clinker prices, fuel and freight cost, currency depreciation, and especially ongoing geopolitical uncertainties, we believe these are mainly near-term challenges rather than structural issues. So looking ahead, we expect the construction sector to gradually recover over the medium to long term, especially ongoing infrastructure projects, post-DITA reconstruction activities, housing development, airport expansion, port city developments, and road projects, including Central Expressway, are expected to continue supporting cement demand. While higher construction cost may slow some smaller private sector projects, we believe most large-scale projects will continue because stopping or restarting them would be much more costly. And at the same time, Tokyo Cement is well positioned to benefit from recovery. The company further strengthened its market leadership during the previous year, financial year 26, by growing volumes ahead of the industry. And with capacity utilization is still around 50%, there is room to increase production without major additional capital investment. We also expect recent investment in coastal shipping and logistics to gradually improve operating efficiency and support margins once external cost pressures begin to ease. So based on our DCF, PER and enterprise value to EBITDA valuation, we arrive at target prices of 104 rupees per Tokyo voting shares and 83 rupees per Tokyo non-voting shares, and therefore maintain our buy recommendation. And the key risk we have considered include, as you can see here, the rupee depreciation, higher raw material cost, fuel and freight cost, pricing competition, delays in infrastructure projects, and a slower than expected recovery in construction activity. So that's all about Tokyo Cement. Thank you for listening, and over to you, Mahesh, for the next counter in the construction industry. Thank you.
Yeah. So next we have Access Engineering PLC. So again, we reiterated our buy recommendation with target price of 96 rupees and 50 cents for FY27. So this is against the current price of 77 rupees and 40 cents with upside around 25% and a total return of around 27% once we include the dividends of 2 rupees. So this thesis, again, we have done three legs. First one is the infrastructure pipeline. So we know that with these reconstruction activities, we can see higher public infrastructure spending and this post-cyclone reconstruction efforts and ongoing flagship projects are there in the government under the government projects. So we believe that those things should support strong demand for construction and material segments in access engineering. And the second one is the diversified earnings. So AEL is usually when we say AEL, the construction sector is the sector which comes to our mind, but they have diversified earnings. So AEL is expanding recurring income streams from commercial properties, logistic assets, renewable energy, and after-sale automotive services, enhancing the stability of its earnings base going forward. And the third one is the automobile segment. So if you go through the previous quarters, you can see the most of the top line is coming from automobile segment recently. So that is mainly because of the pent-up demand we had in vehicle market. So however, going forward, we expect this pent-up demand to moderate and normalize. However, as I mentioned in the previous catalyst, they have after-sales services. So they have after-sales services, spare parts, and there are value-added automotive solutions which should continue to underpin sustainable earnings. So we, considering all these catalysts, we maintain our buy recommendation. So, however, we identified few risks related to AEL. The first one is there can be delays in government project approvals. Funding constraints are there. Cost of inflation in construction materials and execution disruptions from adverse weather conditions and slower than expected recovery in construction activities broadly can impact on AEL performance. So those are the things mainly about AEL. With that, I think we can move on to our next counter.
Yes, moving on to the ACL Cables PLC, one of our top picks with an upside of 41% for financial year 27. So we have been recommending ACL Cables PLC for quite some time. Our recommendation here rests on 4 key pillars. The main one being the recent upward price revisions, considering the increase in raw material prices. A 10% increase in month of April, and followed by another 20% in month of May altogether. There is around like 30% upward price revisions. So these price revision came after a period of margin pressure during the last quarter. Profitability and margins were impacted by rising cost of sales, and that impact was particularly visible in the Kalani Cables PLC, the group's retail sales focused subsidiary. So with this price revision now in effect, we expect the margins to recover. The second one is on the demand side, retail demand remains somewhat steady levels, while institutional demand remains very resilient as per the information we have received. The third pillar is export. ACL export arm, the Cable Solutions PLC, currently focus on expanding into a new destination, a move that will strengthen the group's access to USD earnings and further improve overall profitability. So they are now focusing on new markets. And finally, from the capacity side, the capacity utilization average around 65% at the end of the fourth quarter of financial year 26, with some improvement in the latter part of the quarter. So that leaves ACL with ample spare capacity to serve any pickup in demand without needing fresh capital investment. So on the rich side, you know already aware, still the copper prices somewhat remain elevated. There wasn't any signs of cooling off. While the aluminium prices, we have seen some kind of a decline. However, both the material prices are remain elevated, especially copper, the main raw material, and the LKR depreciation is also kind of a factor that impact on ACL earnings. So in addition to that, the slight increase in interest rate also impact on ACL earnings. So that's all about the ACL Cables PLC. Now we can move into the product PLC.
Yeah. So in my macro outlook, although we said we found a lot of external challenges right now, we have included a couple of export counters as well in our strategy. So the first one is deep products PLC. So here you can see this is again one of the newest addition to our core coverage. So we maintain our buy recommendation here with target price of 68 rupees against current market price of 57 rupees and 60 cents. That implies an upside of 18% and including the projected FY27 dividend of 1 rupees and 20 cents. We expect total return of 20%. So again, we summarized what we found into 3 catalysts. The first one is operating leverage and earnings recovery. So expanded manufacturing capacity, improving global cloud demand and supply chain diversification away from China, all positioned dipped for stronger volumes and margin expansion. And the second one is the operational excellence. So integrated raw materials sourcing, automation, renewable energy initiatives, and cost optimization are enhancing efficiency and profitability in deep production. And the third one is diversified long-term growth. So a broad global footprint and a diversified portfolio of value-added clouds and continuous production innovation and tailwind from the plantation sector give the company multiple paths to sustain earnings growth. However, there are a few risks to monitor, which includes input price fluctuations, exchange rate volatility, climate risk is there, and geopolitical tensions that could affect export markets. So those are the risks we identified. However, overall, DIPT offers one of the more compelling risk-reward setup in our coverage with capacity expansion and margin recovery converging at an attractive valuation, which is why we remain buy. So with that, I think we can move on to our next counter.
So starting off with HECAB PLC, HECAB made an entry to the BRS recommended portfolio in the 2025 mid-year strategy report when the price was around 88 levels. So now we can see a hold rating with the recent price movements in the past couple of days. There's been a quite steep price increase, which limits the upside to somewhat of 7.2%. But we still believe the growth trajectory is in line, and it's a very strong performer. So our target price is 182, and it is driven on the strong demand for gold recovery carbon with the elevated gold prices, as well as the shift towards energy storage carbons, which is more of a niche segment, a high margin segment. And there was a recent capacity expansion in the energy storage carbons. So this will be a key segment going forward for HECAB. So in addition to the recently concluded capacity expansion, there is also the ongoing expansion in Philippines, which will take a couple of years to be fully in place. But this is definitely going to be a catalyst in terms of both market access as well as expanding their capacity. So the key challenges to watch for are the raw material procurement challenges, mainly the coconut shells, and the geopolitical tensions and the tariff revisions. And so those will be the key risks to watch out for. But we still believe HECAB is well poised for an activated growth trajectory. And moving on from there, we have our next pick, which is Digital Mobility Solutions PLC, or commonly known as PICME, with a target price of 200 rupees. We have a buy rating with an upside of 19.2%. So what makes Picnic's performance strong is mainly the operating leverage, where they are able to scale their profits at much less incremental cost, given their business model, mainly driven by the technology. So in addition to that, it mainly came into the market as a ride-hailing company, but the multi-vertical diversification across food delivery, courier, and the marketplace and so on, this gives a very good diversification opportunity and expansion of the business, as well as gaining more revenue per customer. And they are also constantly making investments into technology which boost their efficiencies. So yes, they are exposed to Forex in terms of their software services, and economic factors can affect the consumer affordability. But we believe, given the strong market position and the pricing power, they are able to navigate these risks. So with that, I pass on the slides for the next stock.
Yes. So we added Vidul Lanka this time to our portfolio. As you can see here on the table, we have an upside of 43.5% for the voting share, which gives us an intrinsic value of 32 rupees and a 32% upside on the non-voting share, which gives us a target price of 23. So why Vidul Lanka? So as the facts speak here, it has a very much diversified renewable portfolio. So it has hydro. Since more recently, it has been aggressively expanding in solar, and they also have a Dendra project. So in total, they have about 77 megawatts currently. 25 megawatts being the local hydro and 13 megawatts in Uganda. And Dendra, they have 3 currently. And like I said, the expansion has been quite aggressive in solar, where they have 36 megawatts. So 20 of that megawatt was currently opened in Vaunathu. So that's a JV, a 50% JV between Windforce and Vidul Lanka. So in terms of their future projects, so they have quite a bit in the pipeline. That also, I think, what they are mainly doing with Vidul Lanka. So they did buy a new mini hydro plant, which is included in the 77 megawatts that I did say. So that will be opened, commission. I think it will be commissioned in a month or so. So that has already been added. But in terms of newer projects, they have a 130 megawatt BESS project. I think everyone knows about this project. So that's a battery energy storage system project. Again, that is 50% held by Windforce, and the other 50% is by Vidul Lanka. So this is expected to come into play by actually about end 2027. So if there are no delays, it will be added into the system by end of 2027. But this is more of like a rental project than what they are generating. So they do get a rental income from the CEB for the amount of storage that they have given. So it's more of a rental basis. So in terms of projects, there's a 50 megawatt Mullikulam wind project that's coming up. So that is also a 50% JV with David Pieris Group, and also a 10 megawatt wind project in Puttalam. So both of these projects will be coming in to the system or commissioned. At least it's planned to be commissioned by FY28. So the 10 megawatt will be somewhere around mid 2028, whereas the Mullikulam 50 megawatt project will be at the end of financial year 2028. So these are the newer projects, although it's a joint venture projects. These are quite big projects, and them also in terms of diversification, moving into wind is a plus point for Vidul Lanka, I feel. And also in terms of EPC contracts, so we know that Vidul Lanka was quite successful in the EPC contract it did in Guyana 2 years ago, and that successfully ended in 2025. So there's a new EPC project that they are looking at. They were the lower cost bidders for this project. It's a very small project of 100 kilowatts in Fiji. However, it has not yet been awarded to them, although it was although they were the lower cost bidders for that project. So if that also comes into play, we haven't taken much of EPC contracts into our forecast, but if those projects also come into play, and I think they have a good opportunity in that space as well, we think that Vidul Lanka, with its projects, I think has a very good diversified portfolio with their expertise, and I think that will add to their earnings going forward. So in terms of risk, we know that with renewable energy, it's also highly volatile in nature. So that can have an impact on their production. Also in terms of commissioning these projects, there can be some regulatory approval delays, which we have seen in the past. And also in terms of payment delays by the CEB. So post-COVID, we did see a period of 1 year where there were delays from the CEB. And I think during the current crisis also, there were a few delays, but the money has been coming in now. So in terms of the foreign projects, obviously there'll be foreign exchange volatility. And in terms of most of this project being debt finance, actually, most of the JV projects are 80% debt finance. So any rate increases can have an impact on the finance cost. Overall, we remain bullish on Vidul Lanka. And I think that's it from my end. We can move to Shubha.
Yeah. So let me take you through the last piece of our core coverage. So although again we mentioned that we are not encouraging oil dependent sectors. Here we have Chevron Lubricants Lanka PLC. So that is mainly as a dividend counter. So here we maintain our hold rating here. So we arrived at target price of 208 rupees and 50 cents for 2026. So this is against the current market price of 199 rupees. So there is a modest upside, roughly around 4%. But when it comes to total return, including our forecasted dividend per share of 17 rupees, here you can see we have around 13 rupees upside total return. So that's why we have included Chevron as a dividend counter. So when it comes to investment thesis, investment case rests on 3 pillars. First one is the resilient lubricant demand. So Sri Lanka's aging vehicle fleet continues to support consumption even as high import surcharges slow new vehicle registrations. Second one is the infrastructure and industrial growth. So expansion across ports, logistics, agriculture sector, fishing and power generation should underpin medium-term lubricant demand. And the third one is public sector opportunities. So government-led public transport modernization and recent wins in institutional tenders open additional avenues for volume growth under Chevron lubricant. So, however, still we can see some key risks, which includes fluctuations in base oil prices, climate-related disruptions, exchange rate volatility, government policy and tender outcomes, and geopolitical risk can impact, and also inconsistent performance in export markets, which have around 10 and less than 10% contribution to their top line. So in short, Lub's market leadership is intact and its dividend yield remains compelling, but we are waiting for a clear catalyst before turning more constructive. Hence, we are maintaining our hold rating. So with that, that brings us to the end of our today's webinar. So to sum it up, we selectively overweight banks, insurance, consumer staples, and export-oriented companies, given their resilience across cycles. So within cyclicals, we prefer companies with pricing power and strong cost pass-through while avoiding highly discretionary business and leverage balance sheets. So we hope you found this session insightful. So we'll now open the floor for Q&A. Please send your questions through our Q&A section, and we're happy to take them now. So thank you for joining.
Yes, I think Maheshi, you can stay on. So the first question is for you. That is regarding the gross official reserve forecast figures for 2026. So this, the investor wants to know if this is an IMF or Barclay target is number one.
Okay. So what I have presented here, this 8.2 billion, yes, sorry, 8.3 billion US dollar target for 2026 is our target. So if you want to know IMF target, so their recent projection is 8.6 billion US dollars for this year, but we forecasted, according to our projections, we got only 8.3 billion. Yeah, so that this is basically our projection.
Okay, thank you, Maheshi. So just to follow it up, so we have seen that there has been a recent depreciation in the rupee. I think since January there has been a steep depreciation, and also we have seen the share price, oil prices rise quite significantly, although it has dropped now and risen slightly. But in terms of the central bank, do you think that they will hold the rates at their next policy meeting, or can we anticipate an increase? Do you anticipate an increase rather?
Yeah, so as I mentioned in our macro outlook, so in our base case, we expect to remain overnight policy rate unchanged in the upcoming policy meeting. So we know that we can see temporary challenges. So even during last week, we have seen how the things escalated in Middle East. But we are still remain with our base case forecast. So we think it will take some time to see the full impact of a recent policy rate hike of 100 basis points. So about next policy review, yes, we think mostly it will be they will maintain the same rate at 8.7%.
Okay, thank you, Maheshi. I think we'll take a few questions for Heshan as well before we wrap it up. So Heshan, this question is for you. So we know that the US-Iran war, the situation or the escalations in war situation has been quite severe. So there has been on and off situations. So we have seen that oil prices obviously have spiked. How do you feel that will affect the market outlook? So I think you explained quite comprehensively, but if this situation kind of continues until this year end, what can be your projections?
Yes, Nusrat. So as we, made our base case, our expectation was that yes, you can't, the way the things have folded out, you can't expect a one-way direction. You hear a news or anything that there will be peace talk, and suddenly you hear that it's out of it's blown out of proportion. So it's going to be a wave movement. But the thing is that we have seen that the oil prices correcting, and then again the slight pickup. It's not as volatile as it used to be. So whether that is the market is thinking that again this re-escalation is short-lived. So those are the uncertainties that are going to play out. Now, what we have factored in our base case is that the next few months, the de-escalated situation is going to be the case, and the prices remain at around oil prices remain around $70 to $75 at that range, and possibly come down even below if that the situation to get better. So the initial impact of or the initial effect of initial events, the supply chain disruption, the fact that some of the shipping routes took a detour, and some of the orders didn't come on in time, and the inflation took its place. So all these were expected to place its role or play its role in the second half of this year. Now, if this situation continues for few months, or let's say next 2 to 3 months, that means we have to see the lag effect to an extended period, meaning that sustained tensions periods are actually going to be detrimental, or it's not going to be a good case by any means. So in that case, of course, we'll have to revise our expectation. Our expectation was that the next year going to be a better year. Now, if this situation sustains and the lag effect comes into the first half of next year, potentially the re-rating or the recovery will take further decline, or it will take more time. So in that sense, probably we'll have to go for a bear case situation, which is we are roughly looking at 23,000 as a fair value on a forward earnings. If that is the case, the near term reaction would be the SPI having a hit. So in that sense, even the SPI could go below 20,000 if this is sustained for next few months and the prices revert to the level of $80 to $90 again. So that is going to be quite challenging for Sri Lankan economy. We already had a quite large import bill in last few months. So all in all, I would say if that is the case, our base case becomes slightly bearish, and probably you will see prices shrink a bit. And at that time, maybe for long-term investors, the opportunity would be even more attractive, given that we have seen how the sudden drops have reverted back and paid dividends in the medium to long term. But hopefully, we will see a slight de-escalated or managed situation in the next few months, rather than continued escalation situation that take the oil prices back to 90 to maybe even $100. That is going to be quite impactful, I would say. But for the moment, our expectation is that things will get better in the last few months, at least in this year.
Thank you, Heshan. So I think you largely answered this question, but just following it up, there is also a question about corporate earnings and what your expectations are for this coming June quarter. If the situation continues, and also I think the immediate quarter will have some impact given the cost escalation.
So yes, this immediate that's the expectation that the immediate quarter is going to be the most impactful. But based on our forecast and what we have analyzed and what we have seen, is that although it looks like it's going to be the immediate quarter that is going to be impacted, but it's most likely that it's going to be the third quarter that is going to be impacted, or the September quarter. In a sense, why I would say that is the second quarter, the most of the orders were in line, and some of the demand were intact, and everyone felt that this was maybe a short-lived thing, and they shouldn't worry much. But the implication of disruption usually take at least 3 to 6 months, and to have its impact on the prices, and that is translated into demand being slowing down. So according to our expectation, the June quarter, of course, it's going to be a drop in earnings, but it will be in line with what they have, what Sri Lanka or the CSE has done for the last 2 quarters. And the third quarter is going to be slightly worse off than the June quarter is what we have anticipated. So overall, the first 3 quarters of this year are on a year-on-year contraction, but the fourth quarter is the one that is going to have a recovery in our expectation, That's why you see a broadly resilient earnings on an annual basis. But in terms of numbers, of course, yes, the June quarter will be slightly impacted, but not as severe as maybe the people are expecting.
Okay, thank you, Heshan. Thank you for that answer. So I think we have taken much of time today. So that will be the last question for the day. Thank you so much for joining today's webinar. And this webinar the video will be uploaded into our research portal site. So you can go ahead and watch it there as well. So I would like to wish everybody a pleasant evening, and please do join us for our next session. Thank you everyone for joining, and have a pleasant day.